Checking your own credit score does not hurt it. Closing an old credit card can actually hurt it, and carrying a small balance does not help your score. If any of that surprised you, you've been making decisions based on credit score myths, and it's probably cost you money. Let's fix that in the next 8 minutes. Here's the problem. Your credit score controls more of your life than almost any other number. Yet most people learned about it from rumors, a friend's bad advice, or a comment section, not from anyone who actually explained how it works. So people make decisions based on myths, closing unused cards to clean up their credit, carrying a balance on purpose thinking it builds credit, or avoiding checking their own score out of fear it'll drop. Every one of those beliefs is false, and every one of them can quietly cost you money. Not knowing how your score actually works isn't a small gap. It's the difference between qualifying for a good interest rate and getting stuck with a bad one for years. This matters because your credit score isn't just a report card, it's a price tag. A higher score can mean a lower interest rate on a mortgage, a car loan, or a personal loan. On a large loan over many years, the difference between a good score and an average one can add up to thousands of dollars in extra interest. It also affects things people don't expect: rental applications, some insurance rates, and even certain job background checks in some industries. And here's the part that really matters. Your score isn't fixed. It moves based on specific, knowable actions, which means once you understand what actually drives it, you can influence it on purpose instead of guessing and hoping. Let's look at two people with very different approaches. Person A believes the myths. They close an old credit card because they don't use it anymore. They let their balance ride instead of paying it off because they heard that shows lenders you use credit, and they never check their own score because they're afraid checking will lower it. Over a year, their score drifts down without them understanding why, and when they apply for a car loan, they get a noticeably higher interest rate than they expected. Person B knows the facts. They keep old cards open even if unused, because those accounts add to their credit history and available credit. They pay their balance in full each month because it's payment history and utilization that matter, not carrying debt. And they check their own score monthly through a free app, which has zero negative effect because it's a soft check, not a hard one. A year later, person B applies for the same car loan and qualifies for a meaningfully better rate, purely because they understood the mechanics instead of the myths. So here's what actually moves your credit score and what to do about each part. Step 1. Pay on time every time. This is the single biggest factor. Payment history makes up the largest chunk of your score. Set up autopay for at least the minimum on every card so a late payment never happens by accident. Step 2. Keep your credit utilization low. This is how much of your available credit you're using. Try to stay well under 30% of your limit on each card, and lower is generally better. Paying down balances before the statement closes, not just before the due date, can make a real difference here. Step 3. Leave old accounts open. Length of credit history matters. Closing your oldest card can shorten your average account age and reduce your total available credit, both of which can lower your score. Step 4. Don't open several new accounts in a short window. New credit and hard inquiries make up a smaller slice of your score, but multiple applications closed together can add up and signal risk to lenders. Step 5. Keep a healthy mix of credit if you can. A mix of credit cards and, say, an installment loan can help, but never take on debt you don't need just to improve the mix. It's a minor factor compared to payment history and utilization. Step 6. Check your credit report, not just your score, at least once a year. Look for errors, accounts that aren't yours, incorrect late payments, wrong balances. Reports can and do contain mistakes, and disputing them can raise your score directly. Now, the mistakes people make most often. Mistake 1. Carrying a balance on purpose. Interest doesn't help your score, it just costs you money. Paying in full does the same good for your score for free. Mistake 2. Closing old cards to simplify. This can shorten your credit history and spike your utilization instantly, since you lose that available credit. Mistake 3. Avoiding checking your own score. Checking your own credit is a soft inquiry and has no negative effect at all. The fear here is based on confusing it with a hard inquiry from a lender. Mistake 4. Ignoring credit report errors. People assume their report is accurate by default. It isn't always, and an uncorrected error can drag your score down for no real reason. Mistake 5. Fixating only on the score, not the report. The score is a summary, the report is the actual detail. If something looks off in the score, the report is where you'll find out why. Here's your action plan starting today. Check your credit score through a free app or your bank, and check your full credit report for anything inaccurate. This week, set up autopay for at least the minimum payment on every credit card you have, so a late payment can never happen by accident. This month, look at your utilization on each card. If any are above 30%, make a plan to pay them down before the statement date, not just the due date. Ongoing, keep your oldest accounts open, avoid opening several new accounts close together, and check your full report at least once a year for errors. Your credit score isn't random, and it isn't mysterious. It's a direct reflection of a few specific habits. Get those habits right, and the score takes care of itself. If this helped, subscribe for more breakdowns like this, and comment which credit myth you believed before this video. I might cover it next.